You go ahead, Sangeeta. It's
Yes.
already 6.
Yeah.
Good evening, ladies and gentlemen. It's indeed my proud privilege to welcome you once again for another edition of our evening, and especially this talk this evening is little different from all other talks and seminars and conclaves we do quite often. And before I introduce the distinguished panelists and speakers for this evening, and also share with you why we are doing this event every month after month for your benefit. Before that, let me briefly remind you what's happening in MMA. We have lined up some outstanding events in the month of November as well as December, because we wanted to do some outstanding event when we move from December to January 2022. We want to move on to the new normal, totally charged with so many subjects which we are going to be discussing. And I'll briefly tell you what's happening so that if you have missed in your inbox, just block your diary, make it convenient to attend. Monday the 22nd, we are having a talk by Tarun Mehta. This is under Startup Series. Electric is here. Tarun is co-founder of Ether Energy. He'll be in conversation with Mr. Shankar, founder of CAMS. On 23rd, again, we are very much concerned about health and here stress management, mental and physical well-being. To outstanding doctors going to be talking to you how to manage your thing under these difficult circumstances. So all the questions what you have, the doctors will be willing to answer to you. Please do come, and both are very, very interesting medical professionals, very senior medical professionals. Then on 25th of November, we have again have event on half a century, still at Greece, a journey through 50 plus years of management professionals by Biji Kurian. Is again a former CEO, MD of Berger Pines, and again we have some outstanding panel. Chandilya is chairman of Aisha Group, along with them Ms. Charulata Ravikumar. She's a managing director of Accenture. So we have a high-profile panel. All these events, what I'm telling is happening live at MMA, in-person MMA. So we also know that how much you would like to come back to your normalcy as usual. So we thought in person, but hybrid, you can watch them all live in all our social media portals. On 26th of November, we have modern technologies, moon, bane, or bewilderment. And this is again, we have Professor L.S. Ganesh from IIT Madras and Raju Venkatraman, founder of Medal, will be discussing this. Again, interesting theme, what's happening in the field of technology. Then on Monday, the 29th, interesting conclave, positioning India in the world of new order. It's happening at the Hotel Leela Palace. It's M.K. Narayanan, former National Security Advisor and former governor of West Bengal, along with the very distinguished panel of German delegates. Then we also have Mr. Raghavan, former ambassador. He'll be joining us. So we have some outstanding panel put up on the thing, and where Stanley Johnny from Dr. Stanley Johnny from Hindu will be moderating the sessions. Some of the sessions do come. You can meet some outstanding your colleagues and friends at Hotel Leela Palace. Join us for dinner at the same venue immediately after the conclave. Then on the 7th of December, we have a conclave on reimagining India supply chain to improve the competitiveness. And then beyond the 9th, we have R.K. Swami Memorial Lecture, where Mr. Gurumurthy, you all know Gurumurthy is chartered accountant, and also thinker, author, and editor of Tuklak will be talking to us. I know at least I walk miles to go and listen to Mr. Gurumurthy. Then on 10th, we have watershed, how we destroyed India's water and how can we save it. Mridula Ramesh, you know, she's from Sundaram family, TVS family. She'll be talking to us, and along with two outstanding panelists. Yeah, it's happening on 10th. On the 13th, we have a lecture by K.T. Sweetman from Harvard Business Review. Then on the 16th, we have a implementation of Industry 4.0 post-pandemic world, where Kamal Bali is again president and the managing director of Volvo. Again, we have outstanding panelists here to come and discuss on very, very different subjects. Head of Hyundai, head of TAFE will be talking how to implement Industry 4.0 in manufacturing. Then on 17th, Read and Grow, the topic will be decided. On 18th of December, the great resignation resolution. What we are talking about is now the resignation become a way of life for everybody. Employees perspective. Why happening? What employees should be careful? What's happening to them? And because now it's very attractive job, you resign and go, what is going to be your future? It's going to be continuing for a few years. How do you maintain loyalty in a place where you're working? It's a very, very interesting, this we are doing jointly with MAFI. And then on the 20th, again, component on corporate governance. So there's many more. So I don't want to think, I want to take my time is only 3 to 4 minutes. I've done that. I'll also take this opportunity to welcome all the viewers watching the program live in all our social media portals, Facebook, our webinar, YouTube, Facebook, Twitter, and also our Voice of MMA Radio. As usual, if you have any questions, please do share it, your question, and the numbers which is there on the screen. the distinguished panelists, all the three of them will be delighted to respond, because this is a subject which we are discussing. I'm quite sure elicit a number of questions, because this subject is very, very dear to many people, because all the people want to know what's money about, because money what matters to everyone. So I'm quite sure you'll be more than happy. Now, as I said, why do you are doing this read and grow? Because we always found if you're a leader, you have to be a great leader. Personally, I've seen so many top-notch business leaders coming in MMA, including I've seen some of them outstanding. I won't take the names, who is the best in the country, or some of them best in the world. I've seen all of them are very voracious leaders, so knowledgeable. When you are a voracious leader, I always found them, they're a great thinker, they write well, they speak well. I think these three are done, and you are an outstanding leader. That's why we thought we should bring in this habit of reading. We brought that, and I know physical book, now the things have changed. We also innovated in MMA. MMA, we are bringing some ebooks, a couple of thousands of ebook we are trying, and the negotiation. Next few days, we will have 3,000 to 4,000 ebooks on MMA library and magazines. You can just log in if you're a member and read the books at your convenient time. Idea is we want to encourage the habit of reading, and we are also bringing the virtual library wherein you can register the book which you wanted on our website. It will be delivered to you and picked up the moment you finish it. We are trying to do so many things. Still, the reading is not happening. I can tell you honestly. So we have to do something. We'll do our best. We're not going to let go so easily. And today's topic, again, we had outstanding speakers. The psychology of money, timeless lessons on wealth, greed, and happiness. I think we have three outstanding panelists who will be discussing. The person who will be leading the conversation is Sangeeta Sankaran Sumesh. She is a part of the team which is designing month after month, bringing you some outstanding book with outstanding panelists. Let me have the privilege of introducing the panelists. Thereafter, I'll request Sangeeta to take it on. And Sangeeta has a corporate experience of over 25 years, worked in a number of multinationals. Our last appointment was Dun & Bradstreet of Technologies. Sangeeta is a chartered accountant, management accountant, and completed executive education from Harvard Business School. And she has a number of accolades, including Nightingale Award by the Society of Auditors. She's also under Inspiring Authors of India, Outstanding Professional Award by FICCI. She is an independent director in IAB, married to Sumesh, mother of two, and balance her life, work-life balance. She's also Art of Living practitioner. Very warm welcome to Sangeeta. Thanks once again for taking your initiative to really empower so many people to get into the habit of reading. I think it's really appreciate your support in this regard. Let me have the privilege of introducing Raghu Radhakrishnan, popularly known as Raghu. Raghu Radhakrishnan is the CEO, Managing Director of Timax Soft in India. In his previous avatar, he is also a senior executive position, IBM, and number of other companies, a mechanical engineer from PhD Technology at Coimbatore, over 27 years of experience in sales and marketing. Raghu has significant achievement in his career in building high-performance team from IBM, and Raghu invests in time and energy around reimagining the Tmax strategy and culture, building deep focused software technology portfolio, on becoming one of the top 5 software technology companies in the world by 2025. And I'm quite sure by 2025, India's $5 trillion economy will come to along with you, sir. Hopefully, I hope that happens in sync with your vision. Raghu's personal interests include listening to music, writing, and blog on cricket. I know our event will get over right on time when you will be ready to watch India New Zealand cricket team. Very warm welcome to you, Raghu. It's indeed a pleasure to have you with us this evening. Let me have the proud privilege of introducing Mr. Kumar Subbiah. Mr. Kumar Subbiah is currently the Chief Financial Officer of CEAT Limited, responsible for the finance, procurement, IT, legal, and secretarial functions. He has a rich and diverse experience spanning over 25 years, covering financial management, accounting, business partnering, M&A, risk management, taxation, information technology, and supply chain. He joined CEAT in 2015, and after spending a couple of years, he went on to become a CFO, and he was earlier in Unilever. His last role at Unilever was the finance director, supply chain. Kumar is a BCom graduate from Layla, Chennai, and he is also a chartered accountant, cost accountant, professional interest in both finance and supply chain. In his free time, he enjoys playing flute. His other hobbies are photography, enjoys watching Bollywood movies with family. Very warm welcome to you, Mr. Kumar, and we are going to have a fascinating time this evening, ladies and gentlemen. Do send your questions and interact with the speakers. All the doubt, what you have, you are getting it for free consultation. Ask the question, you will get lovely input. Over to you, Sangeeta. We are all looking forward to your great insights from the distinguished panelists this evening. Over to you, Sangeeta.
Thank you very much, Group Captain. As usual, fabulous introduction. Now, before we get started about the book, I'd like you all to take a moment's pause and think. Have you ever wondered what drives money behavior? Let me share my observation with you. I know of people, some of them even in their 70s and 80s, who even now keep earning money, bungalows, luxury cars, the children well settled, everything, and yet they don't like to part with money, even the smallest amount of money. They like to cling on and hold on to money as much as they can. On the other hand, I have also observed people who are not even sure how they're going to get the next day's meal from, and yet they have a heart as large, and they are ready to share their money with somebody, or even their food with somebody who's not as rich as them. So this extreme contrast I've been observing, and I always have wondered what drives money behavior, and that's exactly why I picked this book, The Psychology of Money. Now, about the book, the author has given brilliant examples, great quotes, and it easily connects with the reader. The moment you read it, immediately you get hooked onto it. So that's like absolutely great. So before the other two panelists dissect the book, what I'm going to do is I'm going to share with you some key takeaways from the book. I'm also going to share some of the quotes, and I'm also going to share things that I think were not so great in the book. So I'm going to give you a complete 360 overview of my perspective of the book. So to start with, what were the three things that really stood out for me from the book? The author, when he starts, he gives an example of a person called Ronald James Reed. What was this person doing? He used to fix cars at a gas station. He used to sweep floors in J.C. Penney. And guess what? When he was 92 years old, which was in 2014, in the year 2014, he had a net worth of, guess how much? $8 million. How was that even possible for somebody who used to be a janitor, right? And so all Reed did was he invested in blue stock chips, and that helped him become from a janitor to a philanthropist. Now, in contrast to Reed, he talks about Richard Fuscon, who was a Harvard graduate. He worked in Merrill Lynch. He retired at 40 because he was one of the very successful people, and he built his dream house, for which he had borrowed heavily. In 2008, he was hit by the financial crisis, which left him with high debt and illiquid assets, and thereby resulted in bankruptcy. So if you were to look at both Reed and Fuscon, Reed did not go to college. He had no training, no background, no experience, nor any connections. And yet, Reed had outperformed the best educated minds. How was that? Simply through investing. So the first thing, the first takeaway I would say is, doing well with money isn't necessarily about what you know. It's about how you behave. And behavior is really hard to teach to even the smart people. So the first thing is, my friends, what is your money behavior is something I'd like you to reflect upon. The second example the author gives, the second takeaway for us, in my opinion, is he talks about a person from our country who grew up in the slums of Calcutta and went on to becoming the CEO of McKinsey. Any guesses? Well, none other than Rajat Gupta. From the slums, how he rose, and then in the year 2008, he had a net worth of over 100 million. But guess what? This millionaire wanted to be a billionaire. So like we know, he was in the board of Goldman Sachs, and he resorted to insider trading, and his career and his reputation got irrevocably reversed, right? So what the author says is, a genius who loses control of their emotions can be a financial disaster. So the key takeaway is, it's never enough unless you say it's enough, right? Then the third takeaway is something very interesting. What he says is, when you see someone driving a nice car, you rarely think, wow, the person in the car is really cool. Instead, what the human mind tends to think is, I would be so cool if I were to drive that car. So normally we tend to think, having an expensive car, a fancy watch, a huge house makes us feel respected and very admired. But my friends, what he says is, more than those materialistic things, it's humility, kindness, and empathy, which will bring you more respect than any of these wealthy stuff. Humans, we are very tuned to judging people by wealth, what we see. We rely on cars, the homes, the social media pictures, but yet wealth is the financial assets that haven't been converted to stuff that we actually see. So he again refers to Ronald Reed's example, where he says he was nobody's financial role model because even the people who were living with him, nobody really knew of what his wealth was. So the third and the interesting point that stood out for me is wealth is not really what you see. So these were the three things that stood out for me. And apart from that, some of these quotes that, one-liners that I found very interesting were, one is, controlling your time pays the highest dividend. The author nudges people to save because he says the ability to do what you want, when you want, with whom you want, for as long as you want is priceless. The second thing is, no one is impressed with your position as much as you are. The third interesting quote is, spending money to show people how much money you have is the fastest way to have less money. And the last interesting quote is, when most people say they want to be a millionaire, what they actually mean is, I'd like to spend $1 million. And he gives an interesting example of singer Rihanna. Rihanna almost went bankrupt because she spent all her money and she went ahead to sue her financial advisor. And the advisor responded, was it really necessary for me to tell her that if you spend the money on things, you will end up with the things and not money? So those were some important quotes that really, caught my attention. And I would also like to share what I didn't greatly like about the book, or things that could have been a little better. I thought the book could have been a lot more crisper, because at few places I thought some of the analogies were a little too long and I thought they were slightly irrelevant. And lastly, I also thought there was nothing very unique about the book, because, especially from an Indian context, where most of us are rather conservative with the money behavior. But yet, what I liked about it in contrast is to re-emphasize the known facts. It's always good to get drilled down with the known facts that we know. So that way, I thought it made a great book. But yes, on the whole, I would really liked the book, and very practical stuff and, relatable stuff. So that's what really, what I'd say I liked about the book. So now let's move on to the panelists. So Raghu, over to you. What are your thoughts about the book, and what is it that you liked about the book? And is there something that you disliked about the book?
Actually, let me start off. Thank you for MMA and Sangeeta inviting me for this discussion. But I guess that you have completed everything. I don't need to discuss anything further. You have covered the entire spectrum and gamut of information that was there in the book. But anyway, let me add few things what you have said, and especially one of the key things is what the book talks about with various anecdotes, small stories, and many things from rags to riches to rags, which you already quoted with many examples, and also the power of compounding. Power of compounding, what he was talking about is talking about how you slowly improve your assets by compounding it on investments over a period of time, long-term investments, quoting examples of Warren Buffett and how he is currently rich, plus also how you need to be patient in terms of addressing the long-term investment plan rather than the short-term goals. Emotions versus intelligent quotients. That's one of the key important aspect that it's clearly given with certain examples. And it also talks about ego, how ego plays an important aspect and the behavior of the person. And with many of the things that is mentioned is possibly related to US, but most of the US centrics are available in India too, which relates to our day-to-day life. And I'm sure this book will provide a complete, this book doesn't provide advice or suggestions how to invest or way to invest, etc. But it provides the, spectrum of various stories and anecdotes and the examples and learning lessons learned, etc., which gives you a fair idea how to take inputs and suggestions and ensure that you don't make similar mistakes what actually happened in the book. That's what its takeaway. But many of the things like ego is a very important aspect of it. How ego drives people to make a impractical financial decision, which brings to complete disaster in their career or in their life, or not only in terms of spoiling their life as well, but also the entire ecosystem or friends that they have. So very clear, good information and practical and reasonable information with anecdotes and stories and mentioned here, and good read. I don't see any negatives about what you identified, but possibly many of the things is related to US, so possibly that those things may not be relevant to India.
Yes, thank you, Raghu. That was a nice overview that you gave. Kumar, what are the things you think a business leader can learn from this book? Like to hear from you.
First of all, thanks, Sankita, for this opportunity. For a Madras boy, a Chennai boy, spending an hour with the Madras Management Association is like, dream coming true. So happy that, I'm part of today's discussion. See, honestly, it's a good book. Okay, and I too agree with you. Maybe it could have been crisper. Okay, but every chapter that I read, okay, 19, 20 chapters, etc., there's always some takeaway. Okay, and more so when I read it the second time. Okay, in fact, I realized, maybe I missed out few points, and there were a few things that I missed out. It was re-emphasized when I read it the second time. A few things, I liked. Okay, I'll come to from the business leaders' perspective also. Like this, the importance of independence or freedom. Okay, and how money can give. Money may not give you happiness, but absence of money can make you unhappy. Okay, and may not covered that well, but certainly one of the takeouts. The example that you mentioned about Rajat Gupta, how to define your own goalpost. Where do you stop? Okay, and $100 million 20 years back or 15 years back was a huge amount of money for a professional. As you mentioned, someone who's had a very humble beginning in Calcutta to become a CEO of McKinsey and subsequently on the board. Okay, how greed took over, and that made him to behave irrationally, and insider information, how it led to many of us work hard to not to make money alone, but also the reputation, what you achieve in life, what you are known for. Okay, what Rajat did in his 35 years of career, okay, that got reversed by just one action where you had passed on the information. That was nicely captured in this book. I think from the business standpoint, what are the learnings? Many a times we do a long-term plan. Financial planners, when you engage with them, they always tell you, how to plan your retirement. How do you need to be financially secured? Even it happens in the business context as well. When you're preparing a long-term strategy, what should our top line be, say, during the end of the strategy period, first phase of the strategy period, what your margin should be, what your market share should be, etc. My takeout as far as this book is concerned, you should be prepared for surprises. Okay, and in the book, he has given some examples of some other surprises. I'm sure all of us are going through one of the surprises that has impacted all of us in one way or the other. I don't think we ever expected Corona will come and hit us the way it has hit us. How do you prepare for those surprises? It's never possible, in human mind, structured plan gives you a comfort. When you go to bed at the end of the night, okay, if oh, I have a structured long-term business plan, and that gives me visibility to how I will deliver my vision. Okay, maybe you can have a peaceful sleep. Okay, but how do you handle surprises? Okay, and surprises would come. Okay, and when you do a long-term planning, how it is important for you to try to get visibility over a short-term and medium term, and how you encounter those surprises in the future, I think determines to some extent the success of a professional or a success of a business. I think that's one of the takeouts from this particular this book, okay, which covers all of that. I think each chapter is different. Okay, of course, some overlap between some chapters, but it's been a huge learning reading books, both professionally as well as personally. That's the way I would like to sum up, Sangeeta.
Great. Thank you so much, Kumar. That was very well summed up. Over to you again, Raghu. So Raghu, there's a very nice line in the book which says, emotion versus fact. It explains why we don't always do what we are supposed to do with money. Now, how do you think we can control our emotions better with regard to money? Because many times I've noticed that, many decisions that we take, be it in the business or even personally, we tend to take emotional decisions. So how do you think we can control our emotions better with regard to money, and any real life example that you would like to share?
Yeah, sure. One of the key things, I'm sure none of us are robots. We are all human beings, and we are all having varied emotions, and varied emotions depending upon. So we need to define two important aspects when you make a financial investment: a decision based on emotional decisions, and also facts-based emotional decisions on the financial investments or expenditure, or fact-based decisions on the financial investments or expenditure. These are the two important. We need to clearly differentiate these two aspects of it. That's very important. Secondly, one of the key thing is, emotional decisions. Sometimes we need to keep it to minimum. It's not that we should not make an emotional decision. We are all attached to many things. I'll give you an example as well, and we need to keep the decisions which impacts our overall percentage of expenditure to the minimum, rather than spending more money on emotions. That's in another important aspect. And make sure that the long-term planning should not get affected by the emotional decisions that you are making it today. For example, all of us are attached to the antiques, or we are all attached to things that comes from ancestors, whether it's a house or a car or whatever it is. In my own example, I wanted to tell you, my grandfather got a first car, which is a baby Austin. It was emotional to everybody in the family. In 1930, he bought a first car in 1930, and it was quite well known in a place called Coimbatore. And it was first-hand car. Most of the Austin cars were second-hands, and it was first-hand car. And we kept it for 46 years. During the course of the time, there were many offers coming in the way. And there were offers coming like, we will replace the brand new Fiat for this car, etc. At the end of the 40 years or 45th year. But that time we were so much attached to that, we didn't want to give a replacement of the car. But at the end of it, we sold it for whatever the reason, we sold it at 4,000 rupees in 1976 to somebody else. Now, after almost another 41 years, I wanted to go back. I somehow managed to identify somebody else who bought the car in Kuno, and I wanted to go back and take the car. That time, whatever the lessons learned that we had, so we were so much attached, we wanted to let go of the opportunity that was coming in the way. Secondly, we sold it at much lesser for whatever the reasons might be. Now, I wanted to go back. That was the lessons learned. We let the opportunity go. Second one is, I wanted to, since we were so much attached to that particular ancestral property or whatever the attachment that we had towards the car, I went back to that current owner and asked him how much can you give it to me. He was ready to give, but he was asking about 20 lakhs for the car. Then I felt that it's quite not correct for the price that you pay. So decide how much you wanted to pay for the emotions. And that's very, very important. And consider emotional attachment is, or you wanted to pay for the emotions, consider that as an expenditure rather than an investment. That's very, very important. So in this particular book, there were a lot of anecdotes given, and I wanted to share my real life experience based on the book, which possibly more or less relating to what I have said just now. So what takeaway is, consider emotional investment as an expenditure rather than an investment, and keep it to the minimum that in your overall investment plan.
Yes, very well said, Raghu. I wish people make these decisions with a lot more awareness, because then they know whether they're doing it from an emotional perspective or, logic perspective. So that was a very nice example you gave about the car. Kumar, the line I have for you from the book is, apart from luck, financial success is a soft skill, is what the author says. So where and how you behave is more important than what you actually know. So in your perspective, what can be done to behave better with money? So basically, this awareness that we spoke about, how can people become a lot more aware of the financial decisions that they're making?
Yeah, I think, a very, very good question, Sankita, here. What happens, when money goes into your head, okay, and sometimes the decisions that you take are not very rational, okay, and for example, the Ferrari car example that is given in the book that you also outlined, you tend to buy an expensive car, okay, or expensive house, hoping, this is going to give huge value in the minds of people who look at you. Okay, that's what, but the book really says that when somebody looks at a Ferrari car, it never looks at the driver who drives the car. Actually, he thinks only about how cool I would look if I drive that car. So in finance part of it, wealth is not in showing off what you have. Okay, wealth is more about sometimes you show by not showing off certain things. For example, in my previous organization, we used to say less is more. Okay, and so similarly, wealth beyond a point, okay, or money beyond a point may not add value. Okay, it possibly it could destroy value beyond a point. So how do you need to behave? Okay, you need to behave at the personal level. Spend on something that is required for you. Okay, don't spend for others. Okay, and don't try to spend money as you also mentioned. The moment you start spending money to please the other person, your wealth starts deteriorating. One. Okay, and second, in terms of once you accumulate money, it is also important for you to understand the importance of how to put that money into use. Okay, while I like that example of the mechanic who was looking saving throughout his life, okay, and when he was gone, okay, people realized he had $8 million of wealth. Okay, and one of the behaviors is that there's no point in accumulating wealth unless you put the wealth into a good use. Okay, investing prudently is one aspect of it. How can you make sure that the money that you have earned is put into a good use? Okay, and similarly, organization, when they create reserves, can they create wealth? How to use that money productively so that you are able to add value to the organization. I think the book also talks about, it is not about high returns that you make in a year. What is important is the consistency. It's possible that you have made less returns than somebody who has also invested similar amount of money, but the continuity of making money, continuity of earning returns is more important than making more money in a particular year or less money in a particular year. So you accumulate wealth, but when your cost that you incur, or when the amount of money that you save is reasonable compared to somebody. If somebody may make earn a higher rate of returns, but if he's not able to save money, or if he's not able to put into use, I think you are better off compared to the other person, while there is no need for a comparison. Overall philosophy of money can never be a goal. Money is a process. Money is something which, humans created over a period of time, more to buy goods and services, more to carry out some transactions where one has to exchange one commodity with the another commodity. I think the end goal can never be a goal, money. The end goal will have to be what money does to the, what you do with the money. So in the organizations, in the business sense, when you create wealth, when you create reserves, etc., how do you make sure that the business you invest into areas which will give you returns consistently over a period of time, rather than saying that I have made money? That's the way I would like to respond to this question on the business context, Sangeeta.
Thank you, Kumar. That was very insightful. Over to you, Raghu. One of the favorite hot topic of the book that all of us have been touching upon. The hardest financial skill is getting the goalpost to stop moving. But of course, it's important. So how would you look at this from a business perspective? Because a business is all about growth and then the targets, you're always trying to get better than what we achieved. So how would you like to look at it from a business perspective?
See, one of the key aspect of the goal, keeping the goalpost is setting the goalpost, right goalpost, realistic goalpost, rather than unrealistic goalpost, and make sure that's the first and foremost important thing. You will find many of the anecdotes and stories given here talks about setting the right goalpost rather than an unrealistic goalpost. That's first point. Second point is have a complete checkpoint over a period of time where you want to achieve the goal. That's very, very important checkpoints that you wanted to do or to achieve the realistic goalpost. And also during the course of the time, you will find many events, many unexpected surprises will come into the picture. So you will have a course correction during the course of the time. That's a second important aspect of setting the goalpost. And secondly, third important aspect is one of the key thing is we are not sure about, we may have a realistic goalpost, goal set for ourselves. We are checking right through, we have planned ourselves better, we do everything right, but we also need to build up a contingency plan. For example, what had happened in the last 1.5 years, it's unprecedented. Even the best of the best brains would have missed it out in terms of building the contingency for that kind of a clear-cut plan to address the challenges that everybody would have faced it. So that's important aspect of it. We need to, one of the key aspects that is mentioned in the book is plan for the surprises. So three things. One is setting the realistic goalpost. Second one is check the path that we are taking regularly to ensure that we are on the right path and do the course correction as and when necessary. Third one is build a contingency plan. If I have to share a few examples of my own personal things, one of the key things is when I said I joined this organization in 2015, and I joined after spending almost 15.5 years in IBM, and this I started from scratch. And one of the key things is I had a very limited play in terms of the finances that was given to us. It was not a play that I had a larger play. So I had to work within the limited financial support that I had. So I always believe that we need to spend as and when the money is coming in, spend less than what we have earned. I never plan for resources or plan for futuristic business that we are going to come in. So initially, to start with, because of the conditions that that I had with and the financial support I had with, I always used to spend less than what I was earning. That's one of the key takeaways. So in the first few years, I always succeeded because I was earning money. And over a period of second and third year, we started seeing the results in terms of achieving the break even, and especially and build I always ensured a portion of the money is built on a corpus. So during the time that I had in 2020 March, we had a strong corpus. And when the rest of the companies were planning to spend much higher, spend more than what they were earning, but I was building the corpus, fortunately. And another important aspect is I was also focusing on my employees' welfare and their growth, and that was also important. That's also part of the planning as well. You need to have a financial planning for your employees as well. So it helped us to build a corpus. At the same time, I didn't overspend thinking of the futurist aspect, which is also important. We need to, but one of the key aspects is many of the people do plan for excessive resources or resources that are available based on the playground that they have. So if you see financial prudence also, it's very depending on the companies. So I was able to manage because of the corpus that I had, never put stress on the people that the employees were going through during the, except for the health reasons that that they had. Otherwise, we had a good financial structure. During that time, we didn't recruit more people, but we had the relevant resources to maximize it and ensured that none of the people were stressed because of the crisis that each and everyone that we were facing. So one thing is made sure that I was playing within the financial structure that I had, didn't overspend, spend below the means. That's very important. And maximizing the capacity that we had during that time, the resources that we had. If you see, another example that I wanted to give is every software organization, this is true for many of the software organizations. If you see software results quarter on quarter, every organization like big giants like Infosys, TCS or something, you can go and check their balance sheet. They will show the amount of financial results or the profitability that they get out of maximizing the resources. If you see some of the examples that I don't want to name those companies, but these companies maximizing the financial returns that they get, maximum utilization of the bench strength. So some people utilize it at 92%, some people utilize it at 75%. So what is the purpose? So if you are able to utilize the existing capacity very well, then you are able to get a better returns or better financial results. That's where you will be able to make a best financial decision, better profitability in the business aspect. You should plan for the future, build the future, but make sure that you are able to utilize the best resources and utilization of existing capacity to the fullest and to the maximum, rather than building up excess capacity and underutilizing it.
Yes, great. The utilization part really resonated a lot with me. Kumar, this is something that as chartered accountants, we would really like this particular line from the book. Plan on the plan, not going according to the plan. So I think this is an excellent tip for mitigating risk. So as a CFO, what would be your advice for a business on this aspect of risk mitigation?
Yeah, okay. First of all, thanks for asking me these questions. Plan is a plan. If plan is going to come fructify every time, then you're not a planner. No, you become an astrologer. So plans are not all plans would succeed. Okay, so plans are, you should in your business plan assume that few things will not go right. Okay, and accordingly, it is important for as a CFO of an organization, when you engage with the organization, it is also important to build some scenarios. Okay, and never assume that everything will go right. Okay, and I have seen this, in my current role. I just want to give one example. As a tire company, we always, added capacities after we reach certain stock out levels. Only after our tires were not available in the market to the extent of 10% of the sales or 8% of the sales, we added capacities. But in 2017, we took a call that it's important for us to build capacities little ahead of demand. Okay, and add that capacity so that when the market demand increases, we are able to you're able to supply tires and not lose out that revenue. what happened? So we committed about 4,000 crores of investment. One of the plants, large plants, is in Chennai, involving about 2,000 crores. In a few months early, we commissioned last year in February. Few months earlier, we commissioned one of the plants in Baroda, and one more plant was about to be commissioned in the month of March at Nagpur. So all capital investments done. Okay, and when we were about to ready, when plants were about to ramp up, suddenly COVID came and hit us. Okay, so therefore, what we thought in our spreadsheet, huge growth, we were expecting with leverage, not over leverage. Okay, and but however, things didn't go as per the plan. It was a surprise that I think Raghu also mentioned about how to manage the surprise, etc. There are only two ways to react to it. One is that you can sulk, feel bad that you're unlucky. That's one way of dealing with it. Another way of dealing with this is how to handle this, how to develop capabilities within the organization to react faster. Okay, how to make sure that the crisis that has come and hit, it doesn't go waste. There's a great opportunity as a finance community within the organization, to make some fundamental and structural changes in the organization. Look, why do we need to spend the money that we originally had planned? Okay, why not we do a zero-based approach for the purpose of looking at cost? Okay, and if we decided to run not all the plants, only some other plants. Again, what Raghu touched about, how to sweat assets. Okay, how do we raise the bar? How do we make sure that you get more out of the existing assets, and how do you plan it? Okay, and how do you manage your cash? Cash is at the end of the day king in such scenarios, etc. I think so. I think finance, the role of finance here is not about demonstrating functional skills. It's so easy to go and tell the business, look, we shouldn't have invested money. I think in the hindsight, it is always easy to say that. But I think the role of finance function is to show little more maturity, little more empathy, okay, and help the business. No problem. I think whatever has happened, because I was also a party to the decision in terms of making the large investments, etc. How do we get best value out of it? Honestly, after last year, maybe in the next 9 months, first quarter was a bad quarter. I think the positive approach to surprises, big surprise, which had a big impact, etc. I think we perform much better than in the previous 5 years. So as a finance function's job is not to say what went wrong. It's also to, partner with the business and ensure that right decision, right structural decision, use that opportunity to make that changes. Okay, second, in an industry like this, even in my previous role, a company, I used to, at a point in time, look after crude derivatives, procurement for Unilever globally. It's always volatile. $1 movement means for us, it used to be, $15 million impact. I don't know, it could be $20 million impact, $1 movement, etc. Huge impact. Businesses are bound to be volatile. World is going to be volatile, etc. So it is about how you deal with volatility. Okay, how do you have risk management processes? One of the things that I used to say, I think it also depends on the role. Okay, when I was not doing a finance role, but full-time procurement role, my appetite to take risk was much more. Okay, but you have to change your approach and attitude depending on the role that you play. Okay, one thing that we always say, look, for example, our own people will come and say, can we hedge Forex differently this way? Can we hedge commodities risk this way? I think as a finance function, we always used to say the risk mitigation process, policies, recommendation that we suggest to the organization should mitigate risk, should not increase the intensity of the risks, etc. So therefore, from wearing a finance head point of view, I think it's very important to do. Taking out from the book, the book nicely covers about margin of safety. Okay, and they've given an example of how Bill Gates at one point in time said, whatever happens, I need to have sufficient cash to pay 1 year's salary. For example, maybe okay, in Microsoft's case, I think they were able to do it. But similarly, somebody else said, I want to sleep well, okay, and therefore I want to make sure that, these certain policies that I will have in the investment will not allow me to close down our business over a 1 year period or a 2 year period, etc. Every organization should have thumb rules. Okay, there is no one standard, one formula that will fit into each other organization. Finance role is to help the organization to find out what that is. Okay, for example, in our case, risk management, when things go wrong, etc., we have certain thresholds. Okay, this is the outer limit as far as our leverage is concerned, within which we will manage. Okay, we'll say no when it reaches this particular level, but however you plan for something better. Okay, or some of the approaches that we have. I think overall, just to summarize, I think as a finance professional, I think one of the things that I try to do. Okay, I don't know right or wrong. Don't go throw a rule book. Don't go and say what is obvious. Don't go and criticize the business at that point in time. Help work with the business, find solutions, and move forward. Okay, so that the respect for your function also goes up over a period of time. Play as a partner, not as some critic. I think that's how I would like to respond. Thank you.
Yes. Nice, Kumar. So I really liked the fact that how the team has to be geared up for any such surprises and be prepared to change with the changing times. That was something very nice. Raghu, for you, what I wanted to ask. At the beginning of my career, one of my bosses had given me a very good advice. The first thing he told me was a car is a depreciating asset. Now, a car, if you were to just look at it as a mode of transport to move from point A to point B, any car can take you. You don't really need a luxury car for that. And that's exactly, something what the author has also touched upon in the book. He says many were mediocre successes, but yet they spent a huge percentage of their paycheck on a car. But we all like, the luxury and, like to indulge ourselves. So how do you think one needs to strike the right balance between having a good lifestyle versus saving? And also living for today versus living for tomorrow, especially amidst all these uncertainties. What is your take on this?
It's this particular question to me is very close to my heart, and I keep using the same example time and again, and the live example. And I'm sure each of us know how Infosys made Mr. Narayan Murthy and the founders have made many people wealthy, and how each and every individual who have been given the requisite amount of shares for their efforts and the hard work that they have put in. And, each one of them have made enough money during the course of the time that they worked with. I just want to give an example, especially when you touched upon a car, when especially the people who have seen sudden success, and this was never there, that, getting the shares at significant lower than the actual market rate was never there before in 90s, and it was set, this trend was set by Mr. Narayan Murthy. And people who have put in efforts, who have been recognized, and they were given the necessary shares. And one of the guy who has been even today, in 1999, when we had a huge amount of shares that was available, for example, he went and sold the asset, that asset which was given as a share, 10 lakhs worth of a asset, to buy a car. Okay, he has been named to get that. He didn't know what to do with that money, and he wanted to ensure that you want to have a good lifestyle. Obviously, he felt elated, and he wanted to ensure that he wanted to have a good lifestyle and made sure that he get it what he likes to feel good about it. He went and invested on a Lancer. So he has been considered as a Lancer M. I don't want to name the person, but Lancer M, Mr. M. So what happened to the value of the car? Today, the 10 lakhs, what he has otherwise would have become multiple crores or more than few $1 million, would have right now, that car that was not required during the time. He was not even married that time. He could have bought even a small car or instead of paying a huge amount of money. So what happened is he went and invested maximum almost 50 to 60% on an expenditure. So I would rather suggest that, delay the expenditure, and you can get that, what you wanted to enjoy at a much, much cheaper rate. That was possibly one of the key things I wanted to give an example. Secondly, you said it rightly. What is the right balance between living for right balance between what was the question? Can you repeat it, please? Right
How
balance.
to strike the right balance between having a good lifestyle versus saving.
Yeah, and also live for today rather than plan for tomorrow. See, one of the key thing is what percentage. See, what percentage of income that you are earning, you wanted to have a good lifestyle. You can always have a good lifestyle at a small percentage of income, percentage of spend for the how much depending on the income that you are earning. So instead of buying an expensive car, you can always buy a car what is you can enjoy with, rather than going for a very expensive car. Learn from others. One of the big investor, I want to give an example, who is also a neighbor investor as well. She possibly, I don't want to name the person. She is a very big investor, invested in many of the startup companies, especially Snapdeal, etc., Mitra. And, she runs a car which is almost 18 years old, Hyundai Accent. And also she maximum money that she would have spent is only Toyota Innova. So what kind of happiness that you get is what important, and spend less where you get maximum happiness. That's one of the key aspect of it. Another important aspect, what I would suggest or possibly recommend is when you are planning for the future, investment for the future, right? Whatever you earn, income minus the investment planning that you have planned for the future, have a secure financial future. Then you spend money. Then you will get a better lifestyle. See, it's very difficult to have a insecure financial future if you want to live for today. I'm not saying that, don't live for today. Live for today. Get your income minus financial planning that you have planned, investment plan that you have done, then go and spend that money. That would be a better idea, or give you a better returns for the future, rather than going and spend the entire money for today and we don't want to live for the future. Nobody is suggesting whatever you earn, you keep saving it for the future. Everybody wants to live life for today, but do it well within your means. What well within your means is income minus future investment plan is whatever the remaining it's available, you spend it for your own happiness. That's what I would like to propose and that's what I've learned from many of the anecdotes and stories from the book and from the real life example.
Yes, excellent. So I always say it's savings first and then expenses. So I think you very well summarized it. So I think we'll have the last question for Kumar, and then we can go for the Q&A from the audience. So Kumar, what I would like to ask you is, we know Jack Welch, how he became famous because ensuring that the quarterly EPS, the earnings per share, it always beats the Wall Street estimates. And it led to consistency and predictability. However, the GE shareholders, they have suffered through a decade of mammoth losses, is what the author says. So what is your take on this as a CFO, and where to draw the line and balance with the shareholders' expectations?
Okay. No, people say there is a thin line between, meeting what investors want and what you have achieved is how do you, meet the expectations and also ensure performance. To me, as a CFO, I think that it is not a thin line, it's a thick line. Okay. And in general, as finance professionals are conservative. Okay. I don't think there was a subject called as principles of conservatism or prudence, etc. in the book, though in the curriculum. Okay. But in general, when I moved into the finance role, I became a little more conservative, a little more prudent. In fact, the book has not gone into details on GE's story, how he managed. So I was curious to understand. I didn't know enough of it. I always admired Jack Welch as a leader, but when I read the book, Winning and others, But just for the sake of curiosity, I try to understand, what happened. It looked like, every quarter, if the investor expectations or shareholders expectation was say 2.55% improvement in revenue, he always delivered 2.56. Okay, so or 2.57 marginally above quarter after quarter after quarter. Okay, and the way it happened was, they relied on GE Capital, okay, and the accounting policies. Maybe during that particular period, quarterly results were not subject to the kind of scrutiny as it undergoes today. The moment you started, it is very difficult to stop. And that's what I feel as a CFO of the company, that when you decide, okay, I'm going to manage my numbers are based on what investors expect or what external stakeholders expect, etc., then you have got into a trap. Okay, it's very, very difficult to come out of it. Okay, no doubt, as a CFO, I always would like to recognize expenses as and when we see those costs hitting our profit and loss account. Recognize revenue when there is a certainty. Okay, that's a prudence, that is a conservatism, etc. But you also save something for rainy days. You like to be a little more conservative when the business has done well, to make sure that the no expenses is unaccounted for, okay, not provided for, and things like that. My philosophy, I think it is not more than the CFO point of view, but leadership is not about consistently delivering results, okay, in line with the expectations. It is also about sometimes having courage to go and tell the external world when we are not done well. Okay, leadership is also about how authentic are you. Okay, I have a feeling, okay, personally, I would invest in companies if leaders come and say, I have goofed up, I made a mistake, I failed in this particular quarter, rather than a company which consistently reports a particular set of numbers. I think it is very difficult, if some company does every quarter after quarter, then you have to be a little more careful. Okay, so that's an very important part of leadership. Showing your vulnerabilities sometimes, okay, you win the hearts of people. It's not necessary, you can deliver certain things when you win the minds of certain people. Okay, you can deliver disproportionate amount of results when you win the hearts of the people. So when you go and say factually what has happened in the quarter in a very authentic way, I think you have won the hearts of the investors and specialists, and they start taking you seriously. It's not about investors. I think even within your team, okay, if they see you authentic, team leadership, bonding happens not when they see you smart. Smart lead people are not necessarily the best leaders. Not necessarily. There are, but not necessarily. But people who you can emotionally connect, okay, you are able to relate better with them, and therefore you connect with them. I think it applies to business. And second, and therefore I wish Jack Welch had courage to show to the world in the quarters that he had not performed, okay, the results also had reflected. Okay, that's my view. And second question is that if finance function, which is supposed to be in charge of or responsible for corporate governance, ethics, etc., it's also an integrity issue here, etc. If they don't fail, if they don't influence the organization to demonstrate the numbers, if you start doing management of performance instead of performing management, etc., I think the CFO of the organization has also failed in my duty. So I think it's a great lesson. There are many successful companies who have failed because of this. For example, Satyam was still a profitable company. Okay, it was making money. I'm sure Raghu would be able to relate to it much better. Okay, but they wanted to meet certain expectations even when they were making money. Okay, they still lost the image, okay, of the organization in front of various people because they resorted to performance management. There's no problem with the overall balance sheet. So therefore, in my view, I think as a CFO, one should also have a courage when you get pressure. I know in today, performance management or performance rewards, a substantial part of one's salary. Okay, so therefore, if you start and there is an incentive to overstate certain numbers sometimes. Okay, I think as a CFO of an organization, it is important to inculcate the right culture in the organization, have courage to go and tell the organization, and ensure that with all the stakeholders, you show what you have done and not really exaggerate with respect to performance. That's the way I would like to respond, Sangeeta.
Awesome. Very well summarized, Kumar. I really loved it. Very valuable inputs by both Raghu and Kumar. I'm sure all the audience are a lot more enriched, and I'm sure they must be waiting to go and read this book as well. So if there are any questions, I would request people to just post it in the chat box and request Group Captain Vijay Kumar to call it out so that the panelists can talk about it.
Sangeeta, can I add one thing before
Yes,
the
please.
questions?
Yes.
I just want to, at the cost of wrath from Kumar, I wanted to make this thing. In fact, in my view on the lessons learned from the various in the last 30 years, I somehow felt that women are a little more practical in terms of the financial investments, and also they are also are better CFOs than men. So don't mistake me, Kumar. Sorry for that. So Sangeeta, it's not to please you or something. It's what I've learned.
Yes, yes. Diversity plays especially the gender diversity. I totally agree with you. It plays a huge impact, and I think people are slowly opening up to it. Yes.
In fact, the people who have got Infosys shares, the women and versus men, the women have got better assets with the lesser number of shares, and than the men who have possibly got more shares and are not that financially prudent. That's the learning that I got earlier.
So India is in the safe hands, is it, Raghu? Woman leading a finance ministry then?
Absolutely. She's a lot more practical. That's why they have put Nirmala Sitharaman there.
So
I think Modi is smart enough to understand who is right. Possibly, maybe that could be the reason.
Thank you, Sangeeta, Raghu, and Kumar. It's like a master class on financial management.
Yes.
I think, as you rightly said, yes.
Yes.
We have got over 600 viewers are watching this program.
Captain, sorry, Dr. Chokulingam is here with us. He wants to make
No, we'll take questions only what has come. We won't open it to anybody because we just got another 7 minutes.
Okay.
So if anything is there, because I only got about 20-30 questions actually. So I'll try and ask 2-3 questions which has come on priority, and that keep coming. Dr. Chokulingam is our member, so if I have time, then we'll open it to him. Here is the question come from Rajkumar, because people have been sending it for last half an hour questions. Mr. Rajkumar wants to know that the stock market is on the high and a number of new issues got oversubscribed. What's your view on this to the people who are going to be looking for investment startup, especially after the Paytm, what happened to the Paytm stocks?
Ask question to me?
Yeah,
it's a question any one of you can, anybody.
See, one of the key things I would like to suggest to all the people, especially the millennials, look for stocks which are performing on long-standing and with a good balance sheet and etc. And with the companies like Tata's and or TCS, I'm just with good credentials rather than I don't want to name how the Paytm etc. and things maybe a temporary, but look at especially when you're a new investor, look for a stock investment which has got a good standing over a period of last 20-30 years. Look for long-term rather than short-term investments and short-term tactical earnings. Always, it's power of patience is important for a new investor.
A question to Mr. Kumar. This is from Geeta, a student from one of the city colleges. Sir, my parents says that it's always good to save money for future. While my friends believe that money can always be earned, but time can never come back. So they talk about enjoying life and whenever we have rather than saving for the future. What's your opinion, sir? You both mentioned we should save for future.
I think she should read the book. It talks about the importance of, Geeta should read the book, importance of savings. Okay, I think Raghu also answered that question in terms of how to maintain a balance between, quality of life and also savings. I think savings is important. Okay, and we could even have some kind of a framework. Okay. There are people who say, my 20% of my salary I will save, irrespective of what happens, etc. So it's important, that example that book covers about, the mechanic, throughout his life, he saved that money. At that money, he ended up with $8 million. So I wish he had put that money into good use during his lifetime. Not that he wasted that money. So I think it's important to maintain a good balance. That percentage could vary depending on individual's lifestyle, but let ego not take over. Don't spend money to please others. Spend money based on what is required. If you want to buy a book, if you want to buy something which will be useful, if you want something to give you that satisfaction, spend money. Okay. Otherwise, don't spend money because of other pressure. That's all I would like to say.
Great. Here's a question from Mr. Franklin from Coimbatore. He says, "Sir, Warren Buffett always shared all his investment plans with everyone and continued to succeed always. But while many of us followed what Warren Buffett said, but we never succeeded. Why is it so?" I think he gave a lot of advices.
The book also talks about this, he says, for each one, there is no like one standard size that fits all. If you're a student at a younger age, your investment plan decisions could be different. Whereas, for instance, if you're a widow who's, much later in age, your investment plan could be different. So there's no really like one standard size for all. So I would encourage Franklin to look through the book.
Okay. Now we got a couple of questions with permission of panelists. Normally we are supposed to end at 7:15. We'll extend for another 5 minutes. We got a number of questions, I think. Is it okay with you, gentlemen? And Sangeeta?
Yeah, perfect.
Yes.
Okay. So here's a question from Babu. He says, how do you balance between ambition and conservation, especially when the paradigm is changing, when we need to think differently? Is there in the chat box so we can see the question? Maybe Ravi would like to take on this question.
Yeah, one of the key thing is, I don't want to suggest or advise anybody else because, things, what is in the past may not be relevant today. Whatever the experience that have gone through the investment cycle or the ambition that each one have got earlier, it may not be relevant today. Each one have to make an investment decision based on what they wanted to look at. It should not be greedy. It should be ambition, which should be able to meet over a period of time. And it should not be a short-term ambition. It should be a long-term ambition. That's what I would recommend. But not that I see. At the same time, the investments also varies time to time. Today, the stock market is good. Tomorrow, the real estate will be good. Day after tomorrow, something will be good. It keeps cycle keeps changing. I don't want to suggest anything. What suits each and every individual based on what their financial goals or assets they want to build. That's what I wanted to leave it to them. It's their decision what their structure, financial structure they have got, what their futuristic earning. That's why I want to leave it to them based on their ambition and the goals that they have set. Set the right goal first, and then step by step, check the steps that you are taking to reach the goal. At the same time, build a contingency plan. These are the three things what I've said earlier applies to here also.
Here's a question addressed to both Raghu and Kumar. Imagine if you are 30 years younger now today, what will be your financial planning?
This is a very good question. In fact, Kumar, you would like to take it? You are
okay. No, okay. Maybe little more exposure to stocks. Looking back, my own investments. Okay, and the book talks. I'm trying to refer this every answer to the book. Book says that your own personal experience determines your own investment decisions. If you are at a particular period when there was a recession, your investment approach would also reflect what you went through. Okay, and I'm from a very humble background, so therefore always try to my father used to say, principal amount you should protect, then only look for returns. Okay, so so from that point of view, okay, maybe a little more. I went for more a conservative approach of investment in my personal capacity, but looking back, maybe exposure in stocks could have been a little more. I think at different age groups, okay, your ability to take risk also varies. Okay, at a younger age, you can take. I think Warren Buffett, one of the reasons for the huge success is that his ability to stay invested for a long period of time. Okay, and whenever multiple cycles he went through, and eventually how he made money. So therefore, younger people can have a little more exposure to stocks. But in stocks, I personally, maybe I may look little outdated. At some point in time, there has to be some visibility to profits. There has to be some visibility to returns and things like that. Okay, I come from that school of thought where it is not about the revenue that alone will give. Maybe a private equity investing in a small startup could have that approach. In the stock market, when the companies hit the stock market, there has to be some visibility, okay, to profits, and that light at the end of the tunnel has to be visible when you make investments in stocks. Is one of the principles I would like to follow. I don't know whether it is right or wrong.
Prabhu, any comment?
I just want to add what Kumar said. I would suggest, or possibly what I have taken is, advance the investments and delay the expenditure. That's very important for everyone. If it's not necessary, for example, I wanted to give one of my nephew when there is a COVID happening in March 2020, and he went and purchased a car. When you can't use the car for next 1 year, right? And he was paying a huge amount of money as a EMI, etc. The initial investment of 4 lakhs, if you had invested on the right stocks, when the market was completely beaten down to the lowest in April, you could have got a car free of cost. So I would have recommended that, advance the investments and delay the expenditure when you don't need it. That's possibly I would like to suggest to anybody. Very, very important. That's what, a person's urge to fall for something which is not required is make the difference between a good investor and a bad investor.
Brilliant, sir. I'll try and take another 2-3 questions before we end. I think we really overshot. Here is a question from Ms. Ananya. How can one business leader become responsive than reactive during the crisis? Have you ever seen any real-time situations from your experience? Would like to share some experience how you are able to come out rather than reactive to the situation?
See, can you repeat the question?
Here is, how can one business leader become responsive than reactive during the crisis? Have you ever seen any real-time situation on these lines?
See, there are many real-time situations. One, I have given my own example, like plan for the worst situation and build a corpus, and then utilize the existing capacity. Don't overspend thinking for the futuristic business. You don't build a capacity when it's not required. For example, it's China versus India. China built a capacity for 10 years when the traffic will hit only after 10 years. And India doesn't plan. It always on somewhere in between. The capacity planning for India is somewhere, take in the case of roads or infrastructure building. China is 10-year ahead, but the capacity utilization is only 10 to 20%. But for them, it's okay. And depending upon what finances that you have, please ensure that you build the capacities in such a way you are able to utilize the existing capacity when the worst situation comes. Don't build the capacity which is bench strength or based on the futuristic business that is you're going to come, and when the worst is going to get hit and you end up sacking so many people and retrenchment, etc. That's where you will find major difference between the over leveraging with many of the startups. They went and recruited so many people planning for the future and possibly end up spending more than what they have expecting it, and sudden crisis comes in, all the people have lost their jobs. So plan accordingly, set the right expectations, set the right goal, plan for the future in such a way that you are able to utilize the capacity that you have built for.
Great, sir. Great. And one last question, then I'll go to Dr. Chokkalingam. He's a famous cardiologist. So he will tell how to take care of your heart by keeping properly track of your money, I suppose. Here's a question. He says, Mr. Raju, he says, we keep hearing about temperament while investing in equities. How do we develop this temperament? Is it by nature it happens, or by practice, or it's by training? How do you do this temperament? Because I see many people keep hearing stay invested. power of compounding. But we always tell, I wish I had done that. It has happened with me too. So how do we develop the temperament?
I think it's an inherent character, right? If you're normally a patient person by nature, I guess that helps. And I think we also need to put the head, head before the heart, because if the heart takes over, we get more impatient, and we want to, wondering what the stocks are like. But I think if we can use the head more, I guess that will make a difference.
You think is it a good idea to go to a financial consultant and take their views? Ultimately, you have to take the call. Do you mean that will help in your temperament to come out of some difficult decision-making
Maybe.
analysis?
Yeah, maybe a wealth management consultant or investment banker. Yeah, probably.
Yes. Shankar, can you request Mr. Chonkalingam, can you get him a call? You want the final comment from Dr. Chonkalingam. Can you make him, can I unmute him and come on screen, please? Dr. Chonkalingam. Dr.
Yes.
Chonkalingam, you have a question? Quickly you're doing, sir. Many people want to watch cricket.
Okay, I'm really happy to be with you all, Captain and dear friends. One minute comment or half a minute comment. And Sangeeta was telling whether you're going to keep the heart or head above or below, please keep it at balance, both the things. Most important thing, please consider your work is a worship, or work as worship, one work and worship. Because we're going to work as a live. The money should be only a byproduct. And don't go for the money at all. Most important thing. Most important thing, you must be able to balance life and work at all the time. In the morning when the share market values goes up, heartbeat goes up. When it goes down, heartbeat goes up. In both persons, they end up with a heart problem, comes to Chonkalingam.
You
So
make money, doctor. That is,
balance.
at the end of the day, it's good, no? Psychology of money, good for you,
No,
doctor.
I don't want to become more richer. I want all of you keep their own money. The reason is, please balance your work and life all the time. After one, you had any number of zeros, Captain. Even 30, 40, 50.
Thank you, doctor. Thanks
As
a lot.
long you are going to keep the one is your existence, your life, then nothing will happen to you. Don't lose the one, add zeros to that. It becomes meaningless.
Thank
My
you.
best
Thank you.
wishes to everyone. Thank you, Captain and dear friends.
Very, very valuable input from a cardiologist. I think I'll take one passing question, which has come and he's sent a couple of messages. Please ask this question. Passing question, final one. He says cryptocurrency is good. The psychology of money, how do you handle this cryptocurrency in the present situation?
Based on your risk appetite is what I would say.
See,
Anyway, the regulations are going to come and maybe regulated soon, I suppose.
See, I just want to add one more thing, the cryptocurrency or nothing substitutes your happiness, peace, and good sleep. And money cannot substitute is that. Make sure that you are happy and then peace and good sleep, because the entire ecosystem, you don't ruin your happiness by substituting with the money.
Brilliant, sir. Thank you, Raghu. Thank you, Mr. Kumar. Thank you, Sangeeta. As usual, it's a brilliant evening. And as a token of our appreciation, this is what we do, because we are separated by distance. And maybe when you come next time to Chennai, Mr. Kumar, you are from Chennai. When you visit your parents or anything, you must visit MMA. You have a beautiful setup art complex in Mount Road. As this is what we do, continue to do so. I think though we are doing very well in terms of pandemic, the mask we give, we do a lot of work around community around us, and we do vaccination. We cover 100% vaccination. We give them a lot of rations. We do winter. We do some regular camps for them, because this is what we thought. Why we do is we do on behalf of you, because you spare your valuable time. Come and speak to us. Large number of viewers watch this. They get inspired, and that I thought a small way of returning of gratitude to each one of you. Thanks so much, and it's indeed a pleasure to have you with us this evening. All the viewers who watch this program, I'm quite sure you would have become much wiser by listening to the three stalwarts in the field of financial management, and take your wise decisions. And I say it's always good to save for future, and it really helps you. I can tell you this personally. Unless you have few lucky people like me and Venkat, we're getting good pension from defense, no issue for us. But also look for a job where you're getting pension otherwise. Thanks so much, and stay safe, stay healthy. Raghu and Kumar, we would like to see you when you visit next time Chennai. Thank you, Sangeeta, once again for the wonderful evening. taking it, the conversation too beautifully this evening. That made it more special this evening. Thanks to each one of you, and bye-bye.
Thanks
Good
a
night
lot.
till we meet again. Stay safe and stay healthy.
Thanks a lot, Sangeeta, and thanks a lot, everyone.
Okay, thank you, Sangeeta, for the opportunity. Thanks, Captain. Okay, thoroughly enjoyed the evening.
Yes. Thank you both.
Thank you, Raghu and Kumar and Sangeeta. Thanks a lot.
Thank
Be,
you.
be my friend up to 100 years. Don't need so can you help as a cardiologist.
Thank you. Thank you for your blessings. Thank you so much.
Yeah.
Thank you.
Thanks a lot.
Thank you. Thank you. I think
Bye.
go and watch the match. I think is doing well now. You have to write a blog